All right, welcome to video number 2 in the series. In this one, I'm going to talk about consistency. Pretty sure that's how you spell that, and why it's so important. And I'm going to use 3 different like equity curves to show why it matters. An equity curve is just how much money you have like in your account. So I'll just say this will be the first trader. They start here, and their money kind of goes up like this, and they end about there, right? So that would be like what a consistent trader, probably a professional trader, that's what their account would look like. It's not a straight diagonal line. You know, they might have had like a bad week right here, maybe a good week there, but in general, it's pretty consistently going up. The way most people's equity curves look, most traders who are amateur traders, it's probably something like this. They start here, they go up, they go down, up. Maybe here they actually run out of money and have to transfer more money from their bank. They get in again, they go, they're having a good time there, but whatever. So your first reaction might be, yes, of course, this is better, this is more consistent. But just to kind of like illustrate it a little better, let's say both of these ended up in the same place. Like, let's say you started with $1,000, on both of these, and you ended with $2,000, right? Maybe that's over a week, over a month, whatever. You could argue, well, these both ended in the same place. Who cares how I got there? Well, first of all, you have your psychology. Because if you're trading this way and you're in one of these periods right here, one of these down periods, you're going to be super stressed out. You're going to be thinking, I suck at trading. My system doesn't work. This whole thing is a scam. It's just not going to be good for you and your confidence and your trading psychology. I'm sure you've heard a lot about that. And I'm sure you've felt all the emotions that go along with the roller coaster of trading like this. The other reason is just practical reasons. If you are trying to make an income from this, even if it's a part-time, full-time thing, you're trying to use the money to pay for your real life, expenses and things. So like if you have a landlord, you can't tell the landlord, hey, sorry, I'm right here right now. So I can't pay the rent until, alt season comes around. And then I'll be able to pay you. Like, no, you have to be able to plan ahead and make consistent gains. And if you want to be confident and call yourself a trader and tell people, yeah, I trade for a living, you can't like not know how much money you're going to be making. This is not an exact amount. You're never going to know exactly how much you make week to week, month to month, but at least you'll have a ballpark idea. You'll know what your worst months are. You'll know what your best months are. You'll know what a bad week is. You know what a good week is. And so it's not just good for your psychology. It's good, practically speaking as well, to try to be as consistent as possible with your games. The third type of trader, and I trade in crypto, and you see this a lot, is people who start here and their equity goes like that, right? That seems ridiculous, but there's people who invested in Ethereum at 50 cents and they made a shitload of money, and that's good for them. I'm not trying to say, oh, they got lucky and that's bullshit. They took a risk, they got the reward. You might have had that happen to you where something went 20x, 10x, and you got really excited. You might have also let it come all the way back to zero and lost it all, and you're kicking yourself for not selling it. But the point is, that's obviously not consistent. You can't do that consistently. I'm sure some people will be able to do it multiple times. Like some people win the lottery multiple times. But if you ask them, hey, do it again, they can't. This is kind of like a Hail Mary sort of thing. That's not to say you shouldn't do it. You can throw some money in on the side on very risky things, and that's fine. But if you're trying to make income and consistent gains and make a living at it, you really do need to realize that this is going to be the way you do it. Obviously this is exciting, and these ups here are steeper than these. You're making more money at a time, and that's the exciting part. But this comes with huge losses, and this comes with having to wait around forever for something to go up, which may never happen. So I think this might be a good time to talk about investing versus trading. And I think there's a lot of people who, especially in crypto, who think that they're investing. They're reading about the companies and the teams and all this shit. But really, I think they're just bad traders, because they are like checking the charts all the time, trying to like buy it low and sell high. And that's even if you're using fundamentals, that's still a form of trading. Investing to me is a long-term thing where you don't care what happens with the price. It's more just I don't want to keep this money in my bank account, so I just wanted to put it somewhere where it's going to gain more, so I can when I need it, to buy a house or to retire or to quit my job or whatever, I can pull the money out. I mean, even if you're investing in real estate, you're still trying to buy here, sell here, and then buy here and sell here. That's just a long form version of trading. And to trade, you need good money management, good risk management, and all that shit. So if you're gonna invest even for fundamental reasons, even long-term reasons, you should still realize that you are trading in some form and try to do it properly. And lastly, this concept here might seem kind of boring, and you might think, well, I didn't get into trading to just make a regular, normal amount of money. I want to make a lot of money. That's why you're attracted to it. And the reality is that if you are consistently making money, your equity curve will probably look something more like this. It'll slope up. And that has to do with compounding gains. Compounding. Because even if if you make $1,000 this first month, that means at this point your account is $2,000. And then if you make, that was a double you doubled your account. So now if you double it, now you're at 4,000. And then if you double that, now you're at 8,000. And eventually all of your trades are getting bigger, your account's getting bigger, your trades are getting bigger, your account's getting bigger, and it kind of slopes up. So you could be trading, $1 million trying to get up to $2 million. That is totally the same as going from 1,000 to 2,000. The point is, you're not trying to get there like this. You're not trying to get there in these huge spikes. You're getting there consistently. You're managing how much you risk. And when you manage how much you risk, usually means you're not going to win as much. So in general, you kind of have to get out of the mindset of, I'm going to make crazy money all at once, that it's going to come slow. It doesn't mean you can't get rich. It doesn't mean you can't make a shit ton of money. It just means you have to kind of curb your expectations of how you're going to get there. So that's it for this video. Again, if you have any questions, put them in the comments or hit me on Twitter. Happy to answer anything. And I'll see you at the next one.